Why does the market keep going up when the news is generally bad? That's a question I'm going to be addressing today. Hello, traders. I've been taking a little bit of time off. I hope you're able to do the same. The market has been rather dull, and that's very typical of the summer session. We get into what I call the summer doldrums. Before we get started, let's take a look at my last two picks. I've been reluctant to give you picks because I'm not seeing a lot of market momentum. PLTR was a long that I gave you last Sunday. I like the stock. I like the setup. You can see how it's flirting with a breakout here. It is in a compression. So until we get a compression breakout through this high, you can try to day trade it when it syncs up with the market, but the stock looks like it's pretty happy staying right in this range. In fact, a lot of stocks have not had much in the way of movement. CAVA is a short that I gave you. You can see how the stock is down a little bit from last Sunday's video, but it hasn't moved a lot. So let's take a look at the market. Let's get our bearings. I want to talk a little bit about what's currently been happening from an economic standpoint, what the news cycle has been, how we approach this as directional traders. So here's the market currently. I'm going to zoom way out. And what I did was I took a screenshot, and I want to talk about how we need to trade as directional traders. Now, first of all, every single person wants to trade like mad every single day. And the problem with that is that as directional traders, we don't have those types of opportunities. So we need to know when we need to pull back and when we need to trade very passively, and we need to know when we can get really aggressive with our trades and ramp up. So let me put up that chart. These are the areas in dark green where we could have truly gotten aggressive with our trading. Now the market goes up a lot more than it goes down, and the market is much more orderly in its price behavior when it goes up than when it goes down. So from a bullish standpoint, that's when we can really strike hard, is when we get these setups. Well, back in 2023, we were coming out of a nice little drop that led us into October. And then I was jumping up and down on my desk in my videos telling you to buy, and buy big and go hard at the market and continue to ride those positions. Even at year end, when I did my 2023 year end video that forecasted what was going to be happening in 2024, I told you, this is an opportunity to buy dips, stay long. And you can see that in this big green box right here. We had the market tailwind that we needed, and many stocks also had relative strength and very strong price patterns like this. This is one of those times as a swing trader when you can get long and you can actually buy options that are 2, 3, 4 months in duration, ride the position, add to the position. These are your moments when you're going to make a ton of money. So you can see that this green box ends here. Go back and verify this in my videos. I started to get a little cautious because this move was very steep and the price action on the upside was starting to get pretty lackluster. We were losing the momentum, and that told me that a dip was coming. Not overly concerning. We just want to gauge the depth and magnitude of the dip. And when you have a nice strong rally like this, you're expecting it to be brief and shallow. That is going to set up another trading opportunity for us. Think in terms of odds. That's the most important thing you can do. So we get this dip down to the 100-day moving average. Okay, are we shorting in here? No, you should not be shorting in here. You are in cash waiting for an opportunity to get long again, and you're simply observing. So we come down and test that 100-day moving average again. Is it time to get long? Not quite yet. Downward sloping trend line. We're above AVWAPQ on SPY. We break out above the 50-day moving average. Beautiful. Now we have everything that we need. Couple of tests off that 100-day moving average, support above the 100-day moving average, and then all the other things that I just explained to you. time to strike and go hard at long positions, especially stocks that have a lot of relative strength that are breaking through resistance on heavy volume. This is where we can really spread our wings and take risk without too much fear that the market is going to blindside us. Same thing in here. We break out, we make a marginal new high. You can ride your long positions in here, but you're starting to take gains because you can see that the market's starting to show some long red candles. This has been a very steep move. We should be expecting that there's going to be a dip. So again, you start taking profits, you go to the sidelines, then we get a nice big drop in here. That was a substantial drop. This was about a 10% drop in a very short amount of time. This was last year, 2024, around the August timeframe. We had the yen carry trade was being unwound. That was a pretty big warning shot. So we had to be very, very cautious. But when we got above AVWAP-Q and the 50-day moving average, we had a little buying opportunity, shaded light green. So yes, we can get long, but not anywhere close to where we were here or here. So now we get another little dip. Okay, we're starting to see dips occur more frequently. We have another opportunity here. Now we have a higher low double bottom. We find support above the 100-day moving average. We get through the 50-day moving average. We get through this downward sloping trend line. This is again where we can get aggressive with our longs because we can see this bullish market trend is super, super strong. But now we're starting to see some choppy price action. We're going into year end. We're expecting a year end rally. So we're looking to buy dips and we're not expecting many. And then all of a sudden we get this little pullback right in here after being very bullish in here. And it's like, oh gosh, I didn't expect a pullback like that. But into year end, everything should be fine. We make a marginal new high in here and we're pulling back. Yes, we could stay long in here, but not very aggressively because this is very choppy price action. This coincides with the December 6th high when I told all of you, go to the sidelines, okay? This is not a good trading setup. I'm seeing lots of patchy price movement, lots of dips that are taking longer to resolve. This is all telling me that the strength of the upward trend is starting to weaken. So now we're going to go into observation mode because our odds are not very high. In here, I started to see nice dips. They were more frequent. We're starting to see resistance build at that all-time high. This is a time to go short. Start looking for your shorts, but bull markets die hard, so we need technical confirmation. Upward sloping trend line right here, breach of the 100-day moving average, boom. Now notice these are not bright red shaded boxes here because we need to be fairly passive after we've had such a strong bull market. And we're always treading on thin ice when we trade from the bearish side. But we had a nice opportunity to get short in here. We were expecting a bounce. We got a bounce. So we took profits into those long, deep drops, and we waited to see how tall that bounce would be, especially when the bull market is just starting to reverse and just starting to transition. So we get resistance at the 200-day moving average. We spend time below the 200-day moving average. Great. Now we know that we want to favor the short side. So we had a good short right in here. Again, couldn't get super aggressive because the price action still remained very choppy, very news driven. So we got short in here. And then at the very bottom here, option implied volatility spiked dramatically. This is where I said, hey, let's sell some out of the money puts on stocks that we really like. We're expecting a bounce. This is a time to be very passive, but we can take advantage of those inflated option implied volatilities. So let's sell some put premium in here. Let's take advantage of the bounce that we know is coming. That was the last decent trade signal that I've seen. And that's kind of where we stopped. And we said, okay, I don't want to be selling a lot of bullish put spreads. I don't want to be selling a lot of naked puts in here because the market could hit resistance right here, and it could roll right over, this being another lower high, and the market continues to sell off. That's not what happened. Okay, the market did gap up on news that we were going to strike a trade deal with China, and since then, the tone has kind of softened. Everybody's not as worried about the tariffs right now. It sounds as though we're trying to get another trade deal done with China. I believe that this move right here, and right now I'm neutral. I've got to be neutral. The technicals are telling me to be neutral. We had this mechanical breakout here after that China trade news, and this triggered a lot of buy stops. So people that were short got stopped out, and that fueled the move higher. I wanted to make sure that this was not a mechanical move, and I would have been looking for a test of these major moving averages, which we got, and then a bounce off of them. And I mean a bounce immediately, and that's what we got. So right now, temporarily, the market looks pretty dang decent. And it's been able to deflect bad news. So let's zoom in a little bit. When you test this breakout right in here in these major moving averages, you want to fly off of that. That tells you that buyers are still aggressive and that they see that as a buying opportunity. And that's what happened. So last week, we tried to break through this horizontal resistance at about 595.50 on SPY. And you can see how we floated a little bit higher this week. Friday, the market gapped up and it was able to hold the gains, but not very convincingly. I'm neutral right now, but I have to tell you, in my heart of hearts, I'm seeing what's happening on a macro level, economically, globally, and I do not like what I see. So the market, I feel, can float higher, probably for another month or so in very light volume. And the reason that I feel it can float higher is because everyone's waiting for the second shoe to drop, and it's not dropping. The unemployment number that came out Friday, 139,000 jobs were created. Okay, better than feared. Certainly not a fantastic number. I believe somewhere in the 127,000 range is what everyone was looking for on Friday. 139,000. All right, great. Well, the wage component was actually quite high at 0.4%. That's inflationary. We had other news last week that came out regarding employment, and I was expecting a weak number on Friday. Call a spade a spade. I thought we were going to see a weak number because ADP came out. 37,000 jobs created in the private sector during the month of May. That was a lot lower than the 111,000 that the market was looking for. Also, we had Challenger, Gray, and Christmas came out with a report on Thursday, and let me just put it up for you. May job cuts in 2025, up 47% over the same period a year ago. So employers are definitely starting to cut back right now. And this number was down a little bit in May, down 12% from April's number. But the point here is that we're seeing more and more job layoffs. And it's not just the US that I'm concerned about, it's actually the global backdrop. When I look at China's numbers, you can't trust China's numbers, but if you start taking a look at all of the other data points that are out there, whether it's shipping or what's happening in their port system or what's happening with their consumption, what companies that are US based are reporting, Starbucks, Apple being a couple of examples, they have to adhere to our accounting standards, so they'll always give you a good read of what's actually happening in China. Las Vegas Sands is another example. So we're seeing very, very light consumption in China. Europe, the ECB just lowered rates again Thursday. This is the 8th cut that they've done in about the last year. They did not project a year ago that they were going to be cutting this aggressively. They are very worried, not about inflation at all, because they're seeing prices come in. In fact, this week we're going to get CPI and PPI, Energy costs have continued to come down. A lot of the reason that those prices are starting to come down is because demand is waning. And so that's why we're seeing contraction in prices right now. The ECB is very worried about their economic growth. Germany, in particular, is very weak. So they cut rates by a quarter point last week. We've also seen rate cuts in China for about the last 10 months or so. They are stimulating as much as they possibly can to no avail right now. You look at consumer companies in the US like McDonald's. Typically, McDonald's has very steady sales. They just announced a 3.7% decline in revenues, levels that they haven't seen since COVID. We've got Walmart citing that consumer discretionary spending is starting to decline. So consumers are shifting to necessities. And that pullback is going to filter into all the economic releases that we see. So what's the timeline for all of this? How is all this going to play out? How are we supposed to structure our trading? I believe that the market is treading water right now because it's waiting for trade deals, perhaps a trade deal with China, perhaps India, some other major trade deals. Japan, by the way, has said they're not going to be forced into having a timeline. They feel that their economic woes, this is an incredible statement about Japan. Their prime minister came out and said that their fiscal situation right now and their economic situation is worse than Greece was in 2009. That's a heck of a statement. And Japan is the third largest economy in the world. So it's very meaningful. Where is this growth going to come from? So I'm seeing all these warning signs, yet the complete focus here in the US has been on the jobs number. If I look at the jobs number that came out Friday, 139,000, oh, yay, good number. Oh, but wait a minute, asterisk, 95,000 jobs were trimmed from the report the last 2 months. So if you strip that out, it's not such a great report. So I'm very concerned that economic conditions are changing. I believe that the big, beautiful bill is going to get passed. The tax cuts are going to get passed. I don't know that it's going to happen in its current form. I think there's a lot of negotiating that's going to be taking place. But eventually, the bill will get passed, and it includes a lot of substantial tax cuts. That is another form of stimulus. And that stimulus is what's propping the market up right now. So as long as that promise of a big, beautiful bill is out there, I believe the market is going to continue to tread water and float higher on light volume. It's going to keep putting pressure on shorts right now. And the market's in a 100-year uptrend. So when there's no news and there's nothing to latch onto, the general trend is upward. And so there's nothing to really stand in the way of that. We have CPI and PPI coming out this week. Both numbers should be decent. I mean, we should see continued improvement in inflation coming out. That's what I'm expecting. That's what everyone is expecting. So apart from that, there's no real news. What about earnings? We could start to see some earnings warnings as we get closer to Q2 earnings releases, but those really start happening in the third week in July, approximately then. And that's when we could start to see some warnings as those earnings approach. Lululemon last week got really hit hard. We can take a look at that stock. They warned. So I think we're going to see more and more of that. So over the course of the next few weeks, let's say from mid-June to mid-July, I think the market's going to be able to continue to float higher. We have triple witching coming out this week. So triple witching typically results in one really volatile day. Could be up, could be down. right now probably would favor the upside, but that is because institutions are rolling their futures positions. And if the market establishes a trend in one direction or the other intraday, that move tends to be exaggerated. They goose that move as they unwind their positions. So watch for a volatile day in there somewhere this week. But apart from that, there really is not a lot of economic news that's going to be released. The path of least resistance right now is up. But again, as we start to get closer and closer to the middle of July, that's when I start to get more and more concerned, because we're going to start seeing a lot of data points coming out across the world that are going to continue to show us economic weakness. By the way, ISM services last week came out at 49.9. That's 80% of our economic activity, and that is clearly in contraction territory. Came in well below estimates. The beige book that came out Wednesday, the Fed's beige book, they said, listen, we're starting to see job losses pretty much across the country. And they gave a regional breakdown, and that's over the course of the last 6 weeks. So this jobs report on Friday really isn't consistent with all the other information that I see out there right now. So I'm looking for the market to float higher on the notion that there's going to be this big, beautiful bill that gets passed. There's going to be stimulus in the form of tax cuts, and that's going to keep buyers engaged. But there's not going to be a lot of conviction. We're not going to see a lot of volume behind that move. And then as we start to get further into July, we're going to start to see some nervous jitters. The Fed, by the way, has been steadfast. Powell said in the last few weeks that he does not see the need for a rate cut this year. So interest rates are going to continue to be high. You can tell that I'm not very bullish at all. I'm mildly neutral, waiting at the first sign of trouble to flip back to bearish, but I do need to see some technical breakdowns before I can get to that point. And when they happen, I'm expecting that this 100-day and 200-day moving average somewhere around the 577 level, they're going to fail pretty dang quickly on the backside. So what do we do until then? That's the problem, is that if you start doing a lot of searches right now, you're going to find that your bearish searches have very, very few candidates, because the market has been moving higher. And that tells you that you really need to favor the long side. Well, given my market bias, I'm barely neutral right now. So what strategy sets up for that? Well, selling out of the money bullish put spreads, or selling out of the money naked puts. That's about as bullish as I can get, and I'm just trying to bide my time over the course of the next 4 weeks or so. So I'm going to show you a trade that's setting up, and I'm going to go into my bullish searches, and I'm going to click Green Royal Flush to see what comes up here. And if I look at these candidates right here, I can just look across to see which ones have green dots. Those would be buy signals across multiple time frames. I do see some pretty decent strength in airline stocks right now. It's not what I'm going to be highlighting, but I like this horizontal level. And if UAL and others can continue to break out next week and get through this horizontal resistance, getting through the 100-day moving average here, that's a pretty nice looking stock and decent price action on Friday. Let me highlight what the price action was on Friday, and we'll take off the extended hours. You can see the market gapped up on a better than feared number, and it was not able to challenge that early high the rest of the day, and the market finished right on VWAP. So pretty lackluster move given that we had a jobs report. So not fully embraced here. And let's take a look at another stock that I have in the list, and I'll show you how I would approach this. This is HUT, and you can see how the stock has been in a major compression. We did have a breakout right here on Friday. I like that. Would I be buying the stock right here, right now? Well, it had good price action. It had decent volume on Friday. So you can see that right here. Probably not. I don't want to get that aggressive with the stock. Could I day trade it? Sure. If the market pulls back and finds support, and this stock pulls back a little bit, like half of this long green candle, and it finds support above this horizontal resistance, would I buy it given that the market's likely to reverse and go higher? Sure, that would be a buy the dip mentality on a stock that's shown us some strength with good volume. Yeah, I like that. What else can we do? Our other alternative is to sell naked puts below this $15 strike price. So I already took a look. The July regular expiration, those $15 puts are bid at 60 cents. I'm going to have to put up $7.50 because I always like to put up half of the strike price when I sell a naked put. So I put up $7.50 in the event that I have to buy the stock on assignment. In this case, I don't think you're going to have that opportunity. But if those options expire worthless, I have to put up $7.50 and bringing in 60 cents. You're going to generate somewhere around a 7.5% return. It's going to take you 5 weeks to generate that return. Some of you might scoff at that. Personally, high probability of getting that reward and a 7.5% return right now in a go nowhere market that has the chance to maybe move lower towards the end of July. This is a nice, safe kind of play, and it's very consistent with keeping your risk exposure very low during a low probability environment. And that's really the point of this whole video. Is you've got a number of different trading strategies that you can employ. Some traders are premium sellers. They're always neutral. They're always adjusting back and forth. It's not the style of trading that I do. I'm directional, and that means that I have to pick my points very, very carefully. And I do not approach every day like it's the same. And there are lots of traders who do that. They just go through the motions, and they're directional traders, and they keep their size the same. They keep their strategies the same. And then they wonder why they go through periods where they have really good results, and then a lot of periods where they gradually give those gains back because they're viewing everything through the same lens. And you can't do that. You've really got to pick your points very, very carefully. Now, if I looked at what would get me excited from a trading standpoint and when might my next opportunity be to really step up to the plate, I'm looking for that mid-August decline. The Fed goes into recess, Congress is in recess, you've got the big, beautiful bill in some way, shape, or form. Whatever trade deals were going to happen are happening. The global macro backdrop is continuing to deteriorate. Tariffs are alive and well, even after trade deals. And then we're starting to see perhaps some supply disruptions. We're starting to see some cutbacks in consumption. So that is when I feel that I'm going to have my moment. And probably from mid-August through October, I think I'm going to have a really, really good shorting opportunity. So what am I doing right now? Next to nothing. I'm going to take some time off. That's what I'm going to do because I don't see things setting up well right now for me. And I think the price action is going to be very, very dull. So I'd like to see a big rejection. Perhaps it's a gap higher with a gap reversal and a long red bearish engulfing candle, and then selling pressure that blows through the 100-day, 200-day moving average and starts to get back below this horizontal support level. That's when I would put on the first leg of a short, and I would be looking to progressively add on follow through below that 50-day moving average. And then I believe that we could see some pretty substantial selling in September and October. Well, what if that doesn't happen? If it doesn't happen, I'm not out any money. I'm waiting for technical confirmation. And if I don't get it, then I'm still waiting and watching to see how all of this plays out. So that's the approach that I would use. Right now, I like this HUT trade. This is going to generate a 7.5% return in 5.5 weeks or so. We've got a holiday in there, which is also going to help because we're going to see lower trading volumes around that holiday. And then we'll kind of see how the dust settles. But I'd be looking for other opportunities like that. You simply need higher option implied volatilities above 0.35. And if you have that, then you're going to have enough option IV to distance yourself from the action and to be able to take advantage of time premium decay. And in this particular instance, if I get a sign on HUT, I'm saying I'm willing to buy the stock at $14.40, which is below this horizontal support level, and it's pretty close to that 50-day moving average. And I've already got confirmation that there is some interest in the stock moving higher. So that's how I'm going to be trading right now. Please leave your comments. Let me know how you're trading. I'll respond to your comments. And I will be doing a video on Wednesday. We will see you then. Thanks so much for watching.
Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.